Do you ever get a sense of deja vu? US markets in trading on Friday night hit another all-time high. The Nasdaq, the Dow Jones, the S&P 500, all at record highs again. And it feels like we've said that more than 50 times this year already. And the gains were broad-based, and it was the usual suspects. Apple up 5% for the week. Google up 6% for a week. Now, let's remember these are trillion-dollar companies. They have market values measured in the trillions of US dollars, and they're up 5 and 6% respectively. These are incredible gains. Tesla up 7.5% last week. Since the big sell-off in April that related to tariffs, the rally back in the S&P 500 has added $15 trillion worth of value to the US share market. These are historic and unprecedented numbers. I've never seen anything like it, and nor has anyone else. This is the first time in history that markets have been in a situation like this. And one of the key drivers, of course, this latest leg up, this greatest value creation that's going on right now, and the most valuable in history, relates to cloud computing and data centers. It's driven by this rush to artificial intelligence and the rush to incorporate it in just about every business, every digital business at the very least. And that rush into AI is fueling a huge rally. Now, the rallies are broad-based, but it's clear the big winners are the owners of the cloud, the data centers, and that's where the market is now turning its focus in terms of share price performance. Now, of course, plenty of other groups are involved. The amount of electricity needed to service these data centers, for example, has not only sent energy suppliers high, but it's seen uranium explorers get a boost as the world weighs up the inevitability of having to find other power sources to drive these data centers. But nonetheless, McKinsey, the global consultants, estimate the demand for these cloud-based computing services will triple by 2030. Big tech has already spent billions and billions of dollars investing in the infrastructure and the processes and the machinery to service this burgeoning demand. But McKinsey estimates a further $7 trillion in investment is needed to meet that tripling of demand by 2030. And so a very significant area of investment, focus for markets and a focus for investors. Now, there are a lot of concerns that a lot of debt has been generated to create these centres. They're very expensive to build. They're on a very large scale to make them work. And the costs of this build and of servicing the debt to build these centres is so high, there is concerns about long-term profitability. But that doesn't seem to be stopping investors at the moment. They're happy to put those concerns to one side, and it's clear the beneficiaries of investor focus are those AI-enabled businesses and those that are facilitating that AI enablement. So the chair of Alibaba has said that the data centres mania at the moment is like a bubble. And there's no doubt the price action is leading that way. But of course, the big trouble with bubbles is there's no way to predict when they'll burst. And the Asia-Pacific data center market is one of the fastest growing in the world. Now, of course, the largest market is in the USA, but the Asia-Pacific data center market is now the fastest growing. So it's an area for local focus as well. And as we turn to our watch list today, you can see where our focus is as well, because we're looking at stocks like Equinix. Now, it's the world's biggest data center holder, and it services data centers as well, providing a mix of services and investment in data centers. Its shares are down 16% year to date, in contrast with the rest of those in this space, but it has a strong buy rating from a number of analysts, and its price targets are generally more than 25% above the current levels. It's trading just below $800 a share, and many of those price targets are much closer to $1,000 a share or higher. So Equinix, one of those rarer examples of what might be a valuation proposition in what is a very frothy space. space. Looking locally, though, we have exposures to various global and geopolitical themes. And Electric Optic Systems is not a cloud computing group, but rather a group that's working on laser technology in defence capabilities to bring down drones, essentially. And this Australian company has shot up 41% over the last month. It's the Defence for Laser Demand has seen it win EU contracts. It only works with those groups that are prescribed and authorised by the Australian government to do so. So it's an official defence parts supplier, but with a gain of more than 450% year to date. Some analysts still have a strong buy on this stock. And the news over the weekend that the Russian forces were threatening the Polish border with drone attacks might see a focus on electro-optic systems today and possibly further gains to add to those already spectacular gains this year. Turning back to the cloud, though, and another potential valuation play is the Hong Kong and US listed Baidu. Now, Baidu is like the equivalent of Google in China. It provides search engine services, but it also is evolving and moving with the AI demand that's driving a lot of investment around the globe. And Baidu is, some analysts believe, in transition now away from its more traditional search businesses and more towards its cloud-based AI services. And that switch in its revenue streams in importance could bring another leg to Baidu's success so far. Now, for the second week in a row last week, it was the strongest gainer of the top stocks in the Hang Seng. And the Hang Seng itself outperformed many other markets as it continues to play catch up on a valuation basis. And Baidu is a great example of why that is the case. Search engine and clouds, it's a lot like Google, and yet this stock is trading at 12 times its earnings, whereas Google trades on around 27 times. So there's a huge valuation gap in directly comparable companies here. And Baidu, despite the spectacular gains we've already seen, might continue to outperform as it closes the valuation gap with its global peers.